What's up, guys? Americana back with another video. So, what the hell happened in crypto last week? Everybody was blaming Trump for the crash, but the real cause was buried in the derivatives market. What appeared to be panic selling was actually a system-wide chain reaction driven by leverage, cross margin, and broken liquidity. So, let's get into the video. What is up, everybody? Wow. Take a sip of my tea right quick. What a crazy Friday. Everything is somewhat back to normal, or as normal as they can be. It's pretty obvious what this week's videos are going to be about. This is my first one that I'm recording here, but pretty obvious what we're going to be focusing on. We're going to look forward, see what's going to happen next. What are we expecting when it comes to this crash? Is alt season a possibility still? Are we still in a bull market? What the hell is going on? So make sure you tune into the videos this week. But good to see relief bounces throughout the market over the weekend, honestly, and into Monday. I'm recording this on a Monday, actually, live stream tonight. So I hope I saw some of you guys there. But yeah, I see a lot of people talking about what caused this crash. Was it Trump? Was it manipulation? Was it insiders, whales? How did this thing go down? I'm not speculating in this video what it was in that regard. Was there insider trading? Probably. Were markets manipulated? Potentially. Did exchanges not uphold the agreements that they have with customers in the sense of what they're supposed to be doing? Likely, right? So all those things that people are speculating, I'm not saying they're wrong. But in this video, we're going to talk about mechanisms that allowed this to happen, right? This concept of this liquidity drain and auto deleveraging and things like that. I do want to preface the video of I am not a mathematician. I believe there's even like computer science within this, obviously high level finance stuff as well. There's hundreds and hundreds of books written on derivatives pricing. If you guys are curious as to what I'm talking about, literally type in like derivatives pricing book or formula or something, and you're going to see the craziest math you've ever seen in your life. So I'm not going to be able to give you a breakdown on that level, but hopefully at the end of the video, one, you'll have some like back end knowledge of why this leverage system in and of itself is extremely risky and things like that, but how it kind of spilled over into the actual spot markets, the mechanisms, I guess we can call it, that actually drove what happened on Friday to happen, regardless of was it manipulation or was it insiders or Trump tweets or whatever. Got all that off. Let me take another sip. And let's get into actually what happened. Again, keep in mind, I'm doing the best I can to explain this stuff, but at the end of the day, I'm not a quantitative mathematician with computer science and physics and finance degrees. So let's get into it. So the first thing you need to understand is there's two completely different sides to these markets. Over here on the left side, we have our spot markets. Over here on the right side, we have our derivatives markets, our leverage trading, things like Bybit, Binance, anywhere where you can leverage trade. These things are two completely separate things. One thing to note about the derivatives trading is that it's a zero-sum game. There's equal amount of money lost as there is won. It's almost like a liquidity pool in the sense of you know somebody's providing liquidity to one side or the other, except they're fighting each other, both sides, all the time with trades and trying to take advantage of mispositioned people and things like that. So everything has to balance out, though, is the point, and it's zero sum. So this is its own little ecosystem over here, and there's no coins being traded back and forth between these parties either. So I want to note that too. These aren't coins being traded. You're not swapping XRP for USDT when you short or buy or whatever. It's simply contracts and USDT, right? So it's these things. It's paper and money flopping back and forth over and over again. Majority of the time, it's denominated in USDT. Has to be denominated in some sort of stable coin, again, because that's easiest. And these two sides represent your buyer and your sellers, and these are bids. If this was, you know, a price chart, the bids might be looking like that as price goes down, and then the sells would obviously be above. But I kind of like this view better. Again, people wanting to go long or short on a coin or whatever have you. So what is this? What's this black line? This is, again, their money swapping back and forth Remember, I said it always has to balance out. So there's a lot of shorts wanting to short, and there's probably going to be a similar amount to more who want to bid. These people, their orders aren't filled yet. It's only people really close into here that are swapping back and forth at whatever price this is. But this black line in the middle is our exchange. So our exchange is playing middleman between all of this, between all of these people wanting to interact and try to get the best of each other in a zero-sum game of leverage trading. The exchange is acting as a middleman. It's providing the leverage, it's conducting the trades, it's executing it, it's balancing all this stuff, and it's taking a fee to do so. So most people are okay with that, but just so you guys know what an exchange does, what it is, how it makes money, things like that. Again, this black line represents the positions, right? So this is, capital margin being put down to take a position and place a bet in the derivatives market. But these green lines here, what is this? Okay, so there's going to be some imbalances naturally within the system. Right? The exchange and the automated market maker, which we'll get into in a second, is going to do the best it possibly can at balancing this stuff out and balancing the funds on both sides. But to help with this, and so the exchange itself doesn't have to take on a bunch of risk, providing the liquidity to one side or the other to balance things out, what do? Funding. So funding rate is going to be your green line, and these are small swaps. It's usually a small percentage every 8 hours or 16 hours or 12 hours or however long the funding rate is between longs and shorts. So if there's more people on the long side, well, then to balance it out, the longs are going to pay the shorts a little bit of money. And inversely, the shorts would be paying the longs if it was skewed the other direction. So that's these small imbalances. And again, automated market maker fills out some of these orders on both sides, and then funding rate kind of takes out the rest. So every time we get through a little section, you see me take a sip, just know we're moving on to the next thing here. Oops. All right, let's see. What do we want to talk about next here? All right. Okay, so obviously I said this is the mechanism that allowed it. In my example, and just for the sake of simplicity, we'll refer to the event that triggered this, Trump tweeting about China. That's what we're just going to call it. Again, you can speculate as to what it is. We're just talking about the mechanisms in this video. But when that volatility event, that trigger entered the market, okay, there is traders getting flushed almost immediately as price reacts to that. Because this was negative news and not priced in, this was going to be your long side traders. So these people, these bids are gradually, getting wiped. That's what you have to picture. They're gradually getting taken out all the way down, but at the same time, they're being kind of instantly consumed with people who are trying to sell on this side. If you guys heard my emphasis on the balance and things like that, you obviously can see how it becomes a slippery slope, especially on a unpriced in event of negative news. But this is still not where things break. The automated market makers are pretty good, and the exchanges are willing to step in and provide liquidity to one side or the other to fill out situations like this. Okay. But if you go deep enough, fast enough, and or there is enough liquidity in the system, okay, you get situations like what we just had over the weekend, okay, on Friday, right? And I don't know if you guys know this, what your experience is with leverage trading, but there's a couple different types of positions that you can take, right? You can take isolated positions, which means if I'm going to risk $5,000 on a trade on 3x leverage, I'm going to put my $5,000 down. I'm going to get $15,000 worth of money to play with. But if that price goes down 33%, because I'm on 3x leverage, that's roughly 99.9, I would likely be liquidated. But I'm only on the hook for the $5,000 that I put in. If I have $100,000 sitting in my trading account, it's going to be unaffected, right? The market could have gone and done what it was going to do. I could have been in one of the coins that went to zero, and my $100,000 would have been fine. Would have lost the 5K, but I was willing to risk it, right? But there's also cross margin positions, okay? So this is a little bit different. This means if I have $100,000 in my in my account, in my portfolio, I guess you could call it, on this leverage trading platform, that means I can at any time borrow against that margin to open positions and or keep positions open. So now picture somebody on a cross margin position, okay, with no stop loss, which a lot of people do, and you really shouldn't, especially leverage trading, but with no stop loss on the position. So if I have, let's just use that $5,000 again, for example. If I have $5,000 on a trade, it's at 3x leverage and it goes down 33% and I'm down 99%. Well, instead of auto liquidating the position and removing my $5,000 from the market, okay, but not touching the $100,000 like an isolated position, it's going to reach into my account over here, my whether it's however it's set up, spot account, just account of USDT pool, and it's going to pull in maybe another $5,000, right? So now I'm only down 50%. I've added more margin to the position. So instead of being down 99%, I'm down 50 something percent, right? 50% even, we'll just call it. So that's how that works, but that'll keep doing it over and over and over again, causing repeated cascades. You guys see the commonality here. It starts with a little news event, and then there's like 3 or 4 things that cause these repeated cascades, whether it's isolated positions or margin positions that continue to cascade through people's entire accounts that they have dedicated to their margin account and things like that. You see how these things cascade. So we're already through 2 of them. And we're not even to the worst of it yet. Okay. What did I tell you? Another sip. Okay, so now the worst variation of this, the worst form of this is a lot of exchanges will allow you to borrow against your spot holdings, right? Your spot coins to go and trade. All right. This is risky. So if I have $100,000 worth of XRP in an account, in my spot account, I can borrow 15, 50, whatever, even 5,000. Again, we'll keep it the same as everything else. This is super similar to the margin accounts. But let's say I have the $5,000, right? I borrowed against the $100,000 in XRP. I go and trade that. Same thing happens to me. No stop loss. Boom, boom, boom. Well, now instead of my $100,000 being completely wiped out and into the system then goes and liquidates my spot holdings, whether it be Bitcoin or altcoins or whatever have you. This same exact system, right, that we're talking about, these are our borrowed coins over here on margin. Well, now when these get sold off, we're no longer talking about paper and contracts. This is now entering our spot area over here, right? This is entering our spot, and these coins are instantly being sold off, okay? And that is what causes this to bleed over into the spot market, okay? There is some stuff that exacerbated this. I believe within Binance, this gets a little bit hairy, hectic for me and things like that. I do know what oracles are. If you guys don't know what oracles are, Chainlink is an oracle. It takes data, whether it be on-chain data or data that's off-chain, and putting it on-chain, takes this data and you can use it. It's like an API that's on the blockchain, essentially, for live data feeds, price feeds, things like that. But a lot of exchanges use these oracles, right? And there was something wrong, or there was some sort of attack on Binance's oracle related to USDE DPEG. So if you guys don't know what a DPEG is, it is when a stable coin, that's always supposed to be worth $1, starts dropping. Can be catastrophic because a lot of people's savings are in stable coins, and there's a lot of like safe yield protocols and things like that built on stables. So I kind of digressed a little bit there for a second, but that was a little bit at play as well. So I thought I would mention. But back to your coins, altcoins, Bitcoin, Ethereum getting liquidated on the spot market via these mechanisms. And again, just take this even a step further, because if you get to a point where a lot of this stuff is happening, not just leverage positions that had positions, but cascading style effects, right? When you get in a position that this is happening, and all three of these things happen that I'm talking about: isolated positions getting liquidated, margin accounts getting wrecked, borrowed, margin accounts against spot getting wrecked. At some point, the exchange, right? The exchange at the end of the day is a business, right? Even though Binance, you need a VPN to trade on there, or a lot of them, there's no KYC and it feels like some sort of dark web site or something like that. At the end of the day, they are businesses, right? And these are smart people who have read the books that I'm talking about, those derivative books. They can do the math that I'm talking about that looks like absolute insanity when you look at it, if you do take the time to look it up. But obviously, I say that they want to protect themselves. They are willing to provide liquidity to an extent via the automated market maker, via facilitating the funding back and forth, via taking a small fee to do so. But at some point, they have millions, in some cases, billions of dollars in reserves and their own spot holdings and, stable coins. They have treasuries, all types of financial instruments that they need to protect. Okay. Not only for customers' funds to be safe, which actually they don't really touch customers' funds, but just to continue operations and things of that nature and do whatever that business is setting out to do. I say all that to say, at some point, they turn this automated market maker off. They turn this thing off. They don't care. They will do it. They've done it before. They did it this time. They'll do it again. And I don't blame them either. I mean, you can have entire exchanges blow up via these cascades if they are continually throwing money into a system that's broken, right? We show this as a spiral, but think about those ant death spirals or something like that. It kind of gets into one of those. And why would an exchange just stick its hand in the middle, right? When they don't need to. It's an unwinding thing. But again, they remove this automated market maker. You can even see this in super liquid markets like Bitcoin and Ethereum. Okay, we had 1 minute candles that were like 10% wicks. So it's absolute insanity. Order books were super thinned out on the bid side. Exchanges were getting clogged. People couldn't get money on exchange. People couldn't transfer. If they did have money, they couldn't buy. All of these things. Market makers were turned off, right? So it was kind of, like, think about trading Bitcoin in 2010 or something on no sort of like centralized way or platform or something. It's just absolute chaos, okay? And it doesn't hit these big players as hard. One, because there's a lot of institutional arms to acquire these coins. ETFs, there's private brokerages and institutional brokerages that you guys have never even heard of. I promise you've never heard of them, right? That fill $1 billion positions and things like that. There's OTC orders. There's all types of ways for money to flow into these major coins. And when I say major, I mean only Bitcoin and Ethereum is what I'm referring to. But money can come in from the outside. As soon as people on the outside see 5-10% dips, I promise you, there's probably somewhere out there some sort of algorithm running that has access to 10-15 billion dollars that literally just sits there, and anytime Bitcoin dips more than 10% in a day, it buys as much as it can, right? Like that's kind of that's just a made up scenario, but that's what I'm saying is like kind of out there for these types of coins, your Bitcoin and your Ethereum, right? So they don't get hit as hard. Again, there's a lot of stuff and everything is being sold off through this kind of arm of the derivatives market here. But with the automated market maker turned off, these things can kind of survive. And we saw that, right? One thing to note is that, there's TradFi money coming into this, right? It doesn't have to be crypto money, whatever. There's traditional finance money coming into this. This arrow I have here, right? Your Bitcoin and Ethereum holders buying and purchasing your major altcoins, right? Your XRP, your SUI, your Solana. What does this represent? This is your smart money. This is your crypto, heavy focused people that have been in the game a while, have experience. Maybe obviously they have access to a lot of money as well. They probably have some institutional money and stuff like that, but it's not fresh money. It's money that's kind of already in the crypto space. But what were they doing at a time like this? I promise you, the people that were up, 4, 5, 600% on Bitcoin, a couple 100% on Ethereum, yes, they were super happy and eager to sell their Bitcoin and Ethereum that was already on exchange, even though price was falling, to go buy altcoins. Okay, because when these were down 10%, these were down 30, 40, 50%. I'm talking about your major big boys down that much. Okay. So this is why you see, these major kind of coins fall in that 30, 40, 50% area, and also get respectful bounces as well. So kind of transitioned a little bit, but explaining how the recovery happens, why it flows the certain way that it does. The fact that, I'm sure you guys see the benefit now, right? I had clients even tell me, like, oh, damn, I see the benefit of being in Bitcoin and being in Ethereum at times, or during times like this, especially because, they weren't hit super hard. And my people who bought Ethereum in June, were still up money, these kinds of things. So just kind of explaining that dynamic. And these are mid caps, meme coins, everything else kind of down here. Automated market maker is going to hit them the hardest. This automatic selling or automated selling probably doesn't hit them too hard. I don't know anybody, borrowing against their Polkadot to go leverage trade, but I'm sure it's a possibility out there. So I'll be honest, don't get hit as hard with this dynamic that hits these major coins up here. But when these dump, obviously these are going to dump, and these get hit super hard when this automated market maker is turned off. I really do hate to break it to you guys, and I know I advocate buying a lot of these laggards and things like that at times, okay? These automated market makers really on a day-to-day basis are kind of saving these coins. They're keeping prices stable, elevated even at times, and the exchanges are motivated to do this because if you could only trade Bitcoin, Ethereum, XRP's price action is terrible to trade. Bitcoin, Ethereum, Solana, maybe Sui, right? If you could only leverage trade those couple of coins, the exchanges would make a lot less money. So if they need to provide liquidity to mid caps and meme coins and all of these other coins and projects, right, via this automated market maker to make price action a little bit smoother, to allow orders to be taken on both sides, right, they're going to collect a lot more in fees. They're going to be a lot more interesting of an exchange, right, having these listings and things like that, because again, these are completely separate from spot market and spot demand and things like that. Okay. So I hope you guys understand that. That's kind of how the recovery happens. Let's see, get into this over here. Basically, just a sidebar that as people were shorting on this as well, the exchanges will sell and or take position on those spot tokens. So it kind of adds, what's it called? A little bit more pressure on the sell side of things, driving that cascade further. But that's really not the main point or the dynamic. But I think we are going to wrap it up here. Pretty good EAP session. I had to present this to clients on Sunday, and I'm doing the live stream on this tonight. And honestly, I'll be honest with you guys, I don't need to pretend to be the smartest person in the room ever. I don't need to pretend to be a genius. And this is about as best as I could grasp some of this stuff. Really do like look up what all goes into derivatives in general and pricing these things and these mechanisms and balancing and all, like it's absolute insanity. But hopefully you guys can understand in a deeper manner that, hey, this wasn't just purely manipulation and a tweet. Obviously, that had to do with it, and there has to be triggers and things like that. But this was, the actual mechanism that kind of allowed these things to happen. So I hope you guys found this one interesting. 30 minutes, 28 minutes on the recording, but hope you guys watched to the end. Gonna keep it short here. We'll wrap it up, and I'll catch you in the next one. Peace.